Okay, in this video, we're going to be talking about change in the state of delivery. So let's get right into it. What is it first? And then we'll go into the examples and then I'll show you how to trade it, etc. So the change in the state of delivery is whenever price makes that switch from bearish to bullish or bullish to bearish, has that change in trend, okay? But the number one thing that you want to look for before you can really establish that price has made that switch, like the thing is, it needs a reason. When I talk about change in state of delivery, it needs a reason to have that switch. Okay. You don't just want to go in and look for like, oh, I think this thing looks cheap, right? I think this thing looks cheap. And oh, look, I see this thing pushing up above this. So I think this is having, no, like it needs a very clear reason to be making that move. Okay. So if you're going to make that switch, you need a point of interest. So on this USDCHF, on this particular day, which is August the 5th, 2024, we came down and we cleaned out this daily sell set right here. If you look at my cursor, if you look right there, look at where my cursor is pointing up, we have daily sell set right there. And then you have also, look right here, see how you have like that imbalance right there? Let me zoom in. You see like right here, we have this imbalance that it completely rebalanced that on that push lower right there. And it took out this daily sell side. That's a point of interest. Okay. We came down and we took care of that. Price has been selling off for a good while here. Like you can see day after day, it's just been running out previous day's lows, consistently drawing down into this sell side down below. But now it's being met with it, so we have a point of interest. Okay. So of course, I'm hunting during my kill zone. Okay. My kill zone personally, this isn't the ICT kill zone. This is, I hunt 3 to 6, and then I hunt 8 to 11. For these specific setups. That's what I get my best results at. That's where I found my best results. Okay. So I have this USDCHF right here. I've already identified my point of interest and it's coming down into that. We're coming down to that point of interest and I end up getting this leg lower right here. Because look, here's 8 o'clock. That's the beginning of New York session. So I'm starting to hunt at this point. I'm starting to hunt for plays, right? So then we get this thing, it comes down right here and then we can see it drops off. And it cleans out this sell set right here, which is low of day. That was the low that was put in prior to London session. So figured that was gonna, so we got this thing getting swept. It came up into like that 1 hour imbalance up above the 20 level up there. So we can understand like why it was rejecting and why that first initial bounce didn't hold. But we've identified, we have our daily, which I just showed you in the higher time frame. We got this thing right now coming down to that daily sell side, that daily imbalance. And I got this thing making a sweep into New York session. It's making brand new lows and it's running out further liquidity. It's making a new low here. Okay. So this thing is already in a deep discount. It's running out daily sell side, daily imbalance. We have a point of interest to actually base this off of. And now we're into New York session. So what you're going to look for the change in the state of delivery is after you have that point of interest taken, after you have that liquidity taken, you want to look at the last, this is a bullish scenario. You want to look for the last bearish candle to make that low to be broken above. So for example, you could see how right here where my cursor is, this is the last candle, the very last candle to make that low of that liquidity run. We run out liquidity right here. We run out that daily sell side, remember as well. So we have this thing, this is the absolute low, the last candle, because the one before that was, you said it was a bullish candle. This is the last candle to do it before having that push up, you see? But it needs a reason, because then you can't just go, again, like it just goes back to what I was saying, you can't just go in and look for any case like this where it's breaking above the last candle. Like you need a significant level to frame it. Okay, that's very important, which we have the daily sell side, the daily imbalance, and well, we have the sweep of low of day right here as well. But the second it comes up and it cracks above and it closes above the opening of that candle right there, so let's zoom in, it becomes valid. There's the opening of that candle. So you see like right there, it closes above it. That is a valid change in the state of delivery right there. And you can see how it opens up right here immediately after it into 9 o'clock. And it comes down and look how it just wicks to it just slightly and then rockets up off that level. You see that? Look how it respects that level immensely right there. I like to look at it like this. Think of it like this is the very best price that you could have gotten. Just think, like, this is the folks, like, this is the absolute low, the absolute bottom of that move before having that big leg up like this, before having this thing curl back up. That's the best prices you could get. And you got to think it's taking out daily sell side. It's got the daily imbalance rebalanced. We're making a new low of day here. It's already in a deep discount. And now you got this as the last move lower. That's the best price you can get. It's literally the best price that you can get. And now you're having this thing ramp back up and have that change in state, like right here. You can get in at the candle close, sure. Or, you know, it allows for a pullback later on. So another thing that you can do, wait for further confirmation, of course, is, and you know, a little bit, and it is like a really good signature to wait for, is that imbalance. You can wait for that as well. You'll miss some plays. You will. But if you want to, you can wait for the imbalance, which you got here as well a little bit later. You get that fair value gap, and you see it comes back down into it later on too, and it reclaims that level of support. Because guess what? That is what now? It is your order block. It is your bullish order block. You see? That becomes your order block. And another question, because this is a single candle, a single red candle. Another question people have is, can it be more than one? It can. But in this case, it is one candle. But it can be more than one. It can be consecutive red candles. It can be a few candles. Like it can be. But in this case, it's right here. This is that point of interest. It's the last one. It's that last candle before doing that. So changing the state of delivery is a very good way to get on board earlier than, like, say, if you're just waiting for a bullish shift and you're waiting for the short-term high to get closed above, etc. Because you can see if you're waiting for the short-term high on this thing, it's all the way up here. By the time it does it, it's all the way up here by the time it does it, and it gives that move. But if you're using this change in the state of delivery, then you're getting it all the way down here. You see how, like, that can give you really good risk reward, extremely good risk reward if that's what you like, right? Now, how do you play something like this though? Like, how do you form a model around this? That's the next question, because now we understand what it is. We understand, like, what it looks like. And again, I'm gonna be giving you several different examples. I don't want to just give you one example, because I kind of want to show what it looks like in different environments. I think that's very useful than just giving one, you know, just one example, right? You kind of want to see you really want to see what it looks like in different cases, like consecutive candles, one candle, etc. And I'm going to show you how to play it in different scenarios. So how do you build a model off this? That's the question, folks. So here's what you need to understand. You need to understand the market structure that you're operating within. But Mike, you just said it's having a change in trend. It is on the 5 minute. Okay. And yeah, it could unfold and become something larger later, as you can see. But if you're like me, because I'm teaching you how I look at it, I like low-hanging objectives. And that doesn't mean you can't still get good risk reward with low-hanging objectives. You can still get like 2 to 1, 3 to 1, even with a low-hanging objective profit target area. But here's the deal. When you're having that change in trend right there on the 5 minute that we were just talking about, it's still bearish. If you just zoom out to the 15-minute chart, the 1 hour chart, it is still technically bearish. Okay. So what you want to do in a case like this is you want to take that most recent deal in range. If it's bearish and you're having this happen right here, like you zoom out to a 15-minute, for example, and it's a bearish case, it's bearish market structure. You want to take that most recent deal in range. How do we find that most recent deal in range? Look at the absolute high prior to having that move lower, and you really want to see, like, take liquidity as well. You see how, like, this high right here where my cursor's moving? You see how this ramped up and it took out this 15-minute buy side? This is the absolute high of that swing right there that was curling up before this thing had that leg lower. It was the absolute high. So what you're going to do is you're going to take that deal in range. And what you're going to do is you're going to find 50% of that deal in range right there. And what you're going to do next is you're going to look up above 50%, and you're going to identify where that next key level resistance is going to be. So you can see how you get an imbalance in here, but look, it would be completely rebalanced in this price action in a premium marketplace. So you see, if you look above 50%, this is where you completely rebalance that price action. That makes for a good target. You look up into what we've considered being a expensive marketplace within this range, and then you target that as like a low-hanging objective area, and it's still phenomenal risk reward too. Could you be more aggressive? You could, but again, I'm teaching you the best way to go about doing it, the low-hanging objective way about doing it. And like if you're using a change in the state of delivery, folks, you're still going to get magnificent risk reward on these plays too, and you're going to be able to get like in and out fairly quickly. Like fairly quickly, just take a jab and go, and you're still going to get good risk reward if you're using the change in the state of delivery a lot of times. But that's what you're going to do, because if the trend's bearish, like my advice is don't be too aggressive with that until it actually shows you that it does want to have a little bit of a higher time frame change in trend. So you understand now you want to rebalance that price action there. All we did was we took the most recent dealing range, we measured that most recent lower time frame dealing range, and we found our key liquidity, our next key liquidity pool within an expensive marketplace within that range. So then, like you can see, it ramps up. Again, we have this imbalance right here that would be completely rebalanced in a premium. You get the 80 level up there as well. So we have this imbalance right here that we want to see rebalanced. So here's the deal, folks. You could get in at the candle close and that's confirmed. Okay? If you got in at the candle close and you did that, and you know you want to target that level because it was changing state of delivery, typically you're going to get earlier entries. That's one of the bonuses. Like that's really one of the biggest bonuses to trading like this, is because you can get in earlier. You can also get better risk reward doing it too. And you could do that. Look, you see what I mean? Like that is such a low hanging objective area too. That's the thing. Like you can get good risk reward and still have low hanging objectives. Okay. You're getting over 2 to 1. And that is extremely conservative PT. That is an extremely conservative PT that you're getting right there. Okay? Don't get caught up on all this over here saying, but look at all that. Look at all that you could have. Stop it. All right? 2.71. There's no reason to be greedy with that. 2.71. You can already like be right as much as a coin flip, folks. As much as a coin flip. And you can clean up. You can absolutely clean up. Make as much money as your heart desires with a fucking coin flip. Let that sink in. So stop worrying about all this over here. Okay, doesn't matter. I'm giving you a framework to operate within right now. I'm giving you a low-hanging objective right here that's still giving you 2.71. There's no reason to be greedy with that. Okay? You're in and out quick, and you're getting good risk reward. That is the bonus to using change in the state of delivery. Because guess what? What comes with it is sometimes, as I was saying earlier, sometimes you are going to be incorrect, and it's not really going to have that. Like that again. Like if you want extra confirmation, then go with the shift in market structure. But what comes with that is later entries. Okay, but you can afford to be wrong, and that's what people don't get. That's what people don't get whenever like this. With bigger risk reward, you can afford to be wrong. You can afford to have more losses. That's the thing, folks. You're going to be wrong sometimes. You got to prepare for that. But it doesn't take much. And you could, of course, wait for the pullback right here if you didn't want to get in at the candle close and gone in right there as well. Like maybe you just wanted the extra fair value gap confirmation in there too. There's really nothing wrong with that if you want to, but you can get in right there because you have something framing it. Again, you're not just getting in because it looks cheap. It has a higher time frame liquidity pool as well to frame it. It has this, it's in a discount. It has the higher time frame level. You want a point of interest to frame it off of. And then once you get that, flipping the switch, you can then target your next key liquidity pool within that most recent range right there. Because that's considered like this is that, again, that's considered because that 15-minute is bearish. But you can still look at the opportunity that you have available to you. Okay, so on this USDCAD, you had both of them play out. The shift, the regular market structure shift and the changes to the delivery. But of course, this is over the change in the state of delivery, so I want to put your focus on that. We had this USDCAD. It came down, and it took out a higher time frame sell side right here with my cursor. You see that swing low. Took out the low of that 4-hour candle right beneath it as well. Like we had this big flush. Look at this big flush right here. This thing came down, and remember, it's already taken out a higher time frame sell side at this point, and now it's making a new low of day right here. Okay, it's already in a discount. It's in a deep discount marketplace and has significant sell side to frame a potential reversal off of. So then after we run out that sell side, and then again, what do we look for? You see, like right here, we ended up getting this, like, look, this is that last move lower. Look right there. That is that last move lower right there for having that leg up. You see how it came down and it took out this sell side right here. Now, this is an example of how it can be more than one candle, the change in the state of delivery. And that's why I really want to, use this example here, because it's not just one candle. It doesn't have to be just one. Sometimes it is just one candle, but it doesn't have to be. It can be consecutive candles. Okay. And this is an example of that. See, like these are the last two candles. The one before that was green. See how that one's red where my cursor is pointing? You see how that one is red as well where my cursor is pointing? And these are the last candles that made a new low right there. Remember, this is the best price that you could have got, the absolute best price that you could have got on that move lower before having that change in trend. You have this thing dipping down into so much liquidity, so much support, and then look. So it closes above the body. Look right there. That candle closes. That's where it clears that. And let me note it on the chart so you can see where I'm talking about the body. I'm talking about the body right there, and then that becomes your order block. Now I get it. Like we actually had the shift. That's actually a 5-minute bullish shift in market, or a market structure shift as well. So you actually had both scenarios in play right there. But I just want to take your focus to the change in the state of delivery, because I mean, yeah, sometimes you'll get both. Like sometimes it'll just be one, the change in the state of delivery, and then those are the cases where I was saying where you'll be able to get a much earlier entry. But then sometimes you get it at the same time, but it's still, it makes for a good lesson, because the lesson here is it can be more than one candle as well. And that's a case of that, you can see. So then you can see it has a big explosive push, and it always is best if it has the fair value gap as well, which I said in the previous example. And then we ended up having this pull back into a discount here too. So again, like you can get in, it's really up to you and how you want to do it. You can get in at the candle close if you want. If the risk reward is there within that range, which we talked about in regards to forming a profit target, then you can target, like you can get in at the candle close, or you could wait for a pullback. It really just comes down to you, and do you want to get better risk reward or not? If you want better risk reward, and it's that simple, just wait for a deeper pullback if you want better risk reward. You see? Because that's going to be your order block right there. So if that's going to be your order block, then you could just wait for a pullback into it, which is what I know, like that's how most people do it. Like that do trade change in the state of delivery. It's just, that's your point of entry to get your entry off of. It's the order block. You think like, all right, so like, what do we say the profit target is going to be? Remember, because I'm not just telling you, what it is here. I'm showing you how you can form a game plan and trade it for like low hanging objective targets. So remember, like we take what? We take that range right here. This is what we call a dealing range, a short-term dealing range. This came up, it took out these highs, and then it had this move lower right here. So what you do is you take your Fibonacci, and then you measure that dealing range now. You find 50%, and then what did we say earlier in the previous lesson? You look above 50%, and I want you to identify where your key liquidity pool is, all right, or key inefficiency is. Again, it can be like in the bearish scenario, that is, like it can be, or I mean a bullish scenario, my mistake. It can be bias of liquidity that you target. It can be an inefficiency that you target. So I want you to look right there. Above 50%, look, hunt above 50%. Right there. You have an inefficiency. You have an inefficiency in an expensive marketplace that you want to target. Okay. And now here's the thing, folks. Go back to the lower time frame, your execution time frame. If you want to target that right there, and say you're just basing all your entries, just to simplify it, that's what you can do. Just base all your entries off the order block, because that's an order block right there. It's a bullish order block. You got in right there. Think about that. You get in like right there. And sometimes you're going to miss it. I guess, there's going to be, the person that thinks they're smart in the comments, saying, I don't know if you would have got filled on that, Mike. I mean, look at that. I get it. I'm using it for this case, for this example, but you're going to miss some plays. Get over it. Okay. That's part of trading. That's a part of the game. You're going to miss some plays. And, I heard, ICT said something really that really hit home about that. He's like, that's a good thing. You know what that means? It means you're getting really fucking precise. It means you're getting really precise. It's a good issue to have. You should welcome it. Okay. But just kind of showing you what's available. Because even like if you did, let's just say you did manage to, right? That's 2.72. I mean, you get your entry even a little bit above that, you're still getting 2 to 1. And that's targeting that imbalance. And guess what? That's a low hanging objective. You're not like swinging for the fences or anything either. It's a low hanging objective target. Very conservative target. And you're getting over 2 to 1. That's a coin. You can like be right as much as a coin flip and smack it out the park. You see what I mean? So like that's available to you. Absolutely available to you right there. And don't get caught up in, looking like, well, but look, it came up and took this. So what if I held to stop it? Stop it. I gave you clear rules. All right. That's always, it's always going to run farther than what you anticipated or what your target was. But guess what? Anything outside your plan is noise. Because you know what? If it came up into that level right there, hit that on the dot, and then rejected, you know what you're saying? I'm glad I took profits. I forgot I followed the plan because look at that thing, it's dumping now. But no, we don't do that because now we're stuck in that greed. So a little psychology lesson, little psychology nugget got to plug in there, right? Okay, so another example, this time on NASDAQ. We had this NASDAQ, it came down right here and you can see it's kind of wild. Like we got a bunch, like you can see like it's kind of wiki and this, what is that though? Well, what that is it's called a stop run. Okay. There are certain signatures to look for that stop run. And a typical signature that you'll see in a stop run scenario is it'll be very wiki, it'll move lower, but it'll end up closing with a lot of wick, very little body on it, because it's telling you that it's having a clear rejection to displace beneath these previous lows. So you can see how price came down right here, and we have like this stop run scenario, and it's running out this sell side right here. Now keep in mind, like the 15-minute market structure here is bullish. That's a bullish trend right there. Okay, and it ran out the sell side within that bullish trend. So it has liquidity taken. But then what you want to do, of course, is you go down to your lower time frame. You see? So this thing ended up having a really big push lower right here. See how this came down around that sell? Let me just zoom back out one more time so you see what I'm talking about. It came down, and look at that. Look right there. Look at this. It came down. It took care of this. It's already super wiki. This is already taking care of Asian session lows this morning. And then we cleaned out this sell side here. And remember, you're changing the state of delivery. It's going to be either that last candle or last series of candles, before you have that leg up after running out of significant liquidity pull. So we have this sell side being taken, 15-minute sell side, and it runs lower right here. You see how it runs out that sell side? And then this is the last candle that did it. Like this candle was what did it. That's what dipped down into that right there. That low, it opened up right here, and then it dips down and it cleans out that liquidity. Okay, at a key time, of course. So we're cleaning out this liquidity right here. And then what happens is we get that strong close. So again, folks, like remember, this is the best price you could have got. That was the best price that you could have possibly got for having that change in trend before it flipped the switch, because that was the last down close candle. You see? And then we get that strong close. So as soon as you get that strong close right there, you could enter. You could buy into the play. You see? And actually on this particular day, I know this is kind of different than what I was saying with the previous, but I just want to go over this example with futures as well. Because like you could target these equal highs, of course, in this point. Like you got these relative equal highs up above. You got relative equal highs up here as well, which would have been a good target. Because the thing is, it's cleaned out significant sell side, Asian session lows, etc. And now we got this change in the state of delivery. We didn't get a retest on this one either. Like it didn't come down into your order block right here. So it just like if you were going to capitalize on this one, it would have to have been on just the candle close, which is an option. Of course, I'm not saying you got to wait for the order block retest. You can if you want. Again, there's a million different ways to skin a cat. But then you can see it did end up giving a nice leg up. So like it's not just, of course, this stuff is not just applicable to Forex. It's applicable to futures as well. Okay. So you can use it over here too. But that's a good example of a change in the state of delivery with futures. That was the last candle that took that liquidity. Then would flip a switch right here with that strong close. Now wants to move higher. And you can see like the risk reward is fantastic. Even if you did do it like that. And again, I know it's kind of different from, because I did give you a strategy for it. Like even with those previous examples, you can see it was very clear outlined rules that I give you with that dealing range, and then looking at within that dealing range. Very clear outline rules here. I'm just using this example because this is something that me and my mentees were talking about today, and I figured it was going to run out these highs right here because you can see we had that strong close. So I'm saying, like, if you got that, if you literally just like marketed into this thing and then you kept your stop, like, because of course your stop would be beneath that low, you could have ran out these highs right here, 1.50, then you could have got about almost 2 to 1 right there. You see what I mean? So even if you get into the candle close off something like that, and you target these clean equal highs up above, I mean, you're getting, 2 to 1 risk reward, folks. That's great. I'm not saying you got to get 2 to 1 risk reward. You can get it 1 to 1 or whatever you want to do with it. I'm just showing you the potential there, and those are highs that we figured were going to get cleaned out here because, you saw it. It's a classic stop run signature on that 15-minute. So you're essentially just looking for that trend continuation. And because you're trading with that 15-minute bullish market structure in a case like this, you can be more aggressive with it. That's one of the things. If you're trading with a trend and you're flowing with a trend, you can afford to be more aggressive. You can run out the highs on something like that if you're flowing with a trend. So, and then that's what happens. It takes care of it, and that was that. Okay, so now we're going to go over an example on oil. So with oil, we had this thing come down here, and it took out this higher time frame sell side. So there's something framing it. There's a reason why this should have a change in trend, because you got this higher time frame level right here that's influencing price. You see, that's the thing. Like you want it to have a reason. You want price to have a reason to make that change in trend. You see how this thing's just getting clobbered? It's just getting clobbered. It's just getting clobbered all the way down into. Oh, and this is a good example too. Before we get into that, like we saw this little displacement here, and actually it did look nice. I'm not gonna act like I didn't think it looked nice. It actually did look nice right there. That little displacement that we saw in oil beforehand, it absolutely did. Even in the 15-minute, it looked clean, fair value gap, strong close. But why did this one? Because somebody may look at this and be like, oh, but look right here. We have that last candle right there. It's running out sell side. It's making a new low here, right? Asian session lows is done with too, so there's liquidity. But then this one didn't hold up, but this one did. The more liquidity you got, the better. Like whenever I have somebody that's coming to me that's looking for direction, there's a reason why when I have now I'm not saying, truthfully, like you can be successful. You can be consistently profitable even without a higher time frame, like 4-hour level or a daily level or anything like that. You can, but if you're starting out trying to find your way, you lack consistency, you need to be utilizing a higher time frame point of interest for your trades, all of your trades. Let me say that again. You need to be utilizing a higher time frame point of interest, because guess what? Your accuracy is going to go through the roof. The follow through that you're going to get is going to go through the roof. So the reason why like this push up, which a lot of people, may look at that, even myself, I thought it looked pretty good actually. I'm not going to act like I didn't, but there's a reason why this didn't hold up and this one did. The reason why this ended up selling off is because it has nothing on the higher time frame supporting it. If you were to go to that higher time frame chart on oil, at that area, there is nothing there. There is nothing on this higher time frame supporting that thing to have that leg up in this range. There was nothing in there. We have these imbalances up here, but they're inverse fair value gaps at this point. So this is your next key level. That's your next higher time frame level. So the reason why, and this is just so important, because price needs a reason to have that change in state of delivery. It needs a reason. Okay, that's why like people go wrong when they just look for like, ICT talks about this as well, about like people like trying to just use every single, down close candle for your order blocks, etc. Like this is a case of that, you see, because it doesn't have anything. It doesn't really have. It does have Asian session lows, but that's it. It doesn't have anything on the higher time frame to influence it. So it pushes up, and then what does it do? It gets crushed. So essentially, it just creates liquidity. And then it takes that liquidity and then it comes down because it's drawing to that higher time frame sales liquidity pool, which it taps into right there. And then guess what? Boom. Now you get your leg up. Now you get that displacement, right? Look, this is the last series. There's 2 candles in this. That's the last series of down close candles down into that higher time frame point of interest before you get that displacement. So I want you to think of it like this. That's the best price you could have got. That is absolutely the best possible price that you could have got before that change in trend. That's a change in the state of delivery. These last series of down close candles, and that makes that what, of course. And yeah, you do got the shift as well, but this is the change in the state of delivery. Look, take the bodies right there. Look at that. Look at that right there. That is your bullish order block on the 5-minute chart. Look at the bodies. So guess what? It pulls back into it. It tests it. There's your entry. You can get an entry there. Or as I was saying, you could just get into candle close if you want to, if you only like the risk reward. Because truth is, this you could have shot for, yeah, you could have shot for several different targets. You could have shot for high of day and ran that out. Or you could have shot for Asian session highs as well, which was valid because not to, get too, because I want to keep this lesson pretty focused on the change in this delivery. And I get it. Like I told, I was going to give you a plan, and I already did give you a plan in the previous lessons. But of course, not every play is the same. So like with this oil, when I was talking about it with my mentees on the other day, like what we were talking about was like this thing's bullish and it's going to be drawn up into these highs up here. Like ultimately, like this thing is it's in a discount. We saw the higher time frame. Now the thing is you got a higher time frame point of interest back in it. It's going to be wanting to drop into Asian session highs up here. So I want you to imagine, like, because you got that liquidity there. If you waited for an entry, say down to this order block, say you were patient, and then you waited for that. Like this is like, it's a valid entry there. And then you can keep your stop beneath that low, of course, because it's always going to be like, that's where you're going to keep your stop at. All right. That's just the easiest way, the most simple way to go about doing it. And if you wanted to shoot for that, it's available to you and you can see the risk reward that you got available. You're not like being overly aggressive either. Like I said, the reason why that's a good PT, folks, is because of a few reasons. Yeah, you got a higher time frame level back in you. You got higher time frame sell side, but you got it in a discount too. And you got the liquidity still there. That's Asian session highs up there. Asian session lows is already done with. So we can anticipate that this is going to be our what? This right here is going to be our Judas swing. That's a Judas swing. There's your change in trend. And then there's your order block, ramps up. You might have got on, let me double check. I haven't checked this yet. You might have got something on you might have got a little bit of an earlier entry on the 1 minute potentially. No, you didn't. Like it's the same area. See what I mean? So, all right. So now we're going to go over this example on NASDAQ. Okay. So NASDAQ, this thing's overall in the higher time frame, very bullish. It's been ramping up for a good while here. Okay. But what we saw on this particular day, which is August the 20th, 2024, we saw this thing come up and like we understood that it was drawn to previous day's highs. What is previous day's highs? Like, let me go to the daily chart so you can see what I'm talking about. So we have this thing ramping up, of course, and we understood that it was drawn to this high right here. Look at my cursor. It was want to run that out because it's still in that upswing. It hasn't got anything on the daily that's really holding it down right now. So the thing is, that's going to be the next key liquidity pool it's going to seek. Okay. So I was anticipating a push up, which we got right here. We had this pullback to 1 hour imbalance and it ramped up, but it's taken out again, previous day's highs, but yeah, Asian session highs as well. Buy side liquidity right there. But here's the thing. What's the storyline? Well, the storyline is we have this thing already in a deep premium. Sure, it's bullish, but it's already in a deep premium. And now I got this thing in London here, taking out previous day's highs, Asian session highs, while it's already in a deep premium. You see what I mean? That's a big liquidity pool. So I understand that this is where I want to be hunting. Because I have that significant liquidity grab, remember? That's a higher time frame level too, by the way. Okay. So I got a higher time frame level here. And I got this thing coming up. And it comes up. We have like that strong close initially right here as you look at my cursor, that 15-minute. But then we saw this next 15-minute candle right here open up, take out that high. And then it had like this weak close. Now right there, I love seeing that. Right there. That gave me just 100% conviction on this thing that it was going to sell off. Why? Because each candle tells a story. Now, in regards to that because I know there should be some people like, what do you mean by each candle tells a story? You need to watch one of the previous videos that I made on this topic. Like, by utilizing this signature, your shifts and your change in the state of delivery, like, it's going to, your probabilities, if you utilize like this one little tip right here, it's going to go through the roof. It makes a big fucking difference whenever you utilize this key tip right here. A big difference. But in short, you see how this came up? It took out the high of that previous candle and it closed weak right there. Each candle tells a story. So look how it closed weak with a lot of aggression to the downside. Oh, and by the way, for that video, I'll leave a link to that in the video description. Okay. So you can just go to the video description after you watch this, and then you can go to that video about how each candle tells a story. But it has that weak close, right? And then, like, the thing is, once I see that weak close like that, then what I want to see, because now I got the internal range liquidity created to the downside, it's going to want to seek that. Because think of it like it took this liquidity up here and that liquidity right there, of course, to higher time frame level, and it rejected it. Price is telling you that. You didn't predict nothing. Price is telling you that. All right, you can see it on the chart that it rejected these highs, and then right here coming to 345, it closes like that. And what does it create down below? Once it does that, what it creates down below is a fair value gap. So think about it like this. This is an easy way to think about it. It didn't respect that liquidity, so what liquidity is it going to seek next? Because price moves in the direction of least resistance. There's a lot of resistance there. It's telling you that. So the least resistance is going to be this imbalance. But what happens is price has a pullback before coming down into that imbalance. So guess what? That draw is still there. And the liquidity is what gives it validity. All right? So we see this thing pushing up. Go your 1 minute. But here's what you see, folks. You had your change in the state of delivery right here. See these series of up close candles? These are the absolute, this is the absolute final series of up close candles right there before you had that displacement to the downside. Okay. And I kind of gave you a little nugget, a little tip with that candle closing the 15-minute to get higher probability plays like this, but that's your change in the state of delivery. Those are your last series of up close candles. You see that right there? And you take the body, of course. So, of course, like once it does this, once it actually gives that close right there, sure, you can do that as well. But it was higher probability once you got that 15-minute confirmation as well. So then you get to saying it pulls back into these levels right here. So you could enter short off that right there. You could literally enter short right there. You could target that low right there, or you could, of course, target the sell side down below. And I know, when I say this stuff, right, just to make this clear, people be like, hey, look at this guy. He's going in hindsight and just cherry picking these charts, right? ICT's talking about these types of people, right? How they just go in market replay, or they just go in their hindsight charts and they just cherry pick what they want because they want to sound fucking smart and they want to sell courses. Well, here's the thing. This was not hindsight. I called it beforehand, and I ain't trying to sell you a damn thing. Okay, so let me just eliminate that right now. Okay, because I know it looks like that. And I say that because I know it looks like that when I go into these charts like this. Because there's just tons of traders, tons of people do that, right? Then they want to prance around and act like they are something smart when they're just going in hindsight charts. But guess what? I do this. This is what I do. Okay, right there. I'm illustrating. There's your shift plugged. Oh, would you look at that? Time-stamped. Interesting, right? And then look right here. Oh, look at that. Time-stamped. Interesting, right? Oh, look at that. Same exact move. Illustrating it's going to move lower. Interesting, right? Oh, would you look at that? Illustrated 15-minute draw. Remember we just talked about that imbalance a second ago? Interesting, right? And then that was actually another scenario we can go over here in a moment, which had good fall through too. But I just got to come with the receipts sometimes because it is understandable. So we have this thing. It comes up, and that's our change. That's our order block. That's your bearish order block right there. See that? So you can get an entry right there, of course. Then you could target the lows or shoot for these lows down here. Clean out that sell side and get really good risk reward if you want it. There it is, folks. Like, this is the best price that you could have got. The absolute best possible price that you could have got before that thing just got clobbered. So when price returned to that origin of where that little upswing was created, like there's going to be interest there, and then that makes for a good entry. You see, comes up, and you can just see the potential that's available to you with that. And then a little bit later, because here's the thing, price is fractal. Because then we had that was on the lower time frame, but then we had that 15-minute too, which you just saw plugged in you just saw that chart in Discord as well that I plugged, like right after that you saw just a moment ago. Because then we have this 15-minute shift right here that happened. And then guess what? What do you got right there? Same exact deal. Same exact deal. This is your bearish order block. 15-minute change in the state of delivery, and then comes back up, reclaims it as resistance. It's your opportunity to get on board, rolls over. Same exact deal. That was the last leg up that took that major buy side, because again, you need the liquidity to frame the play. You're not just going in looking for any old candle. You need something to frame it. And that framed it. And then it sells off. And in New York, we had a little bullish scenario. So I'll show you an example of that too. Because this thing ended up rolling over, and it took care of Asian session lows already. It was making new low of day. So I figured, of course, this thing was going to have a nice little retracement to the upside. Like the thing is, like, yeah, it's selling off here, but when it's having this sell off like this, down into all this liquidity like this, it's leaving behind what? It leaves behind internal range liquidity in the process on that leg lower. So now we're coming to New York, which is, you know, a time where you want to be hunting. And then I had this set up down here as well that I'm going to show you. And then right here on the lower time frame. So we had this thing, right? It got clobbered, as I was just showing you. And then that was that 15-minute internal that was left behind. Why is that important to note? Because that's going to be a draw. Okay. And, you know, I'm like, we're looking at this range. This thing's taking off significant sell side here to the downside. And now I have this inefficiency up above right here. And what happens? Right here. Last series of down close candles. What do we call that? Your bullish order block. Look. 1, 2. Series of down close candles. Dipping down into that liquidity. Right there. See that? You get your fair value gap in there as well. Take your Fibonacci. From low to high. Voila. You got a discount. So guess what? You can get in right there at a discount, run out this high, or you could ran it up into this imbalance up above in a premium within that little Dylan range right there. You see what I mean? And then again, you can see the risk reward available. Oh, what do you know? I got receipts again. See? So not hindsight after all. So I'll plug these charts. I call this stuff on mic as well. Am I right all the time? No. Yeah, with this, like, I'm not right. I'm wrong as well. I'm not acting like I'm perfect. Nobody's perfect. Not any single person, any single trader. Doesn't matter who you are. Everybody has losses. I'm just illustrating, like, if you utilize these signatures, then you'll be right more times than not. And then guess what? You know what you call that? Well, that's what you call an edge. And an edge, that's all you need to be successful. Okay. So I hope y'all enjoyed, though. Got immense value out of this video. If you did, leave a like, subscribe to the channel. I'll catch you later.